afternoon, and welcome to the second in a series of 4 Federal Grant Administration webinars, Grant Cost and Allowability 101. Given the number of attendees, it is clear this topic is extremely important for economic development districts and other federal grantees. I am Lori Thompson, a Deputy Executive Director with the National Association of Development Organizations. Because our speaker has a lot of ground to cover, if you are not aware of NATO and our programs, I invite you to learn more by visiting our website at nato.org. Before we start, I'd like to acknowledge that the webinar series is provided under our EDD Community of Practice Initiative, which is generously supported by the U.S. Economic Development Administration. The webinar will be recorded and posted on nato.org soon after it is completed. We encourage you to complete the evaluation that you will also receive after this webinar ends. As I mentioned, this is the second in a series of 4 webinars. The first webinar covered single audits, and the remaining 2 are indirect cost recovery for RDOs, which will occur on October 2nd, and purchasing goods and services with federal grant awards, which will occur on October 9th. In addition to the webinar series, we will be offering 2 Federal Grant Administration sessions during our upcoming annual training conference in New Orleans, which will be held October 21 through 24. One session will cover the distinction between the roles of grant recipient, subrecipient, and pass-through entity. The other will provide insights to the updated OMB uniform guidance. Information about these sessions and the conference can also be found on our website. Our speaker for the webinar series is Bob Lloyd. No doubt Bob is familiar to many of you, as he has been an important fixture at many of our conferences and events. Not only is he a respected authority on policies and practices affecting the award, administration, and oversight of federal grants, contracts, and subawards, he is a strong advocate for the work that RDOs do across the country and the work NATO does for RDOs. His bio statement is included in the slide presentation, which will be available on the NATO website shortly after the webinar. I want to note that Bob will respond to as many questions as possible at the end of his presentation. Please use the chat bar on your screen to pose any questions. You will see that we have attached a few documents that you can download. Bob will be referencing them throughout his presentation. They will also be available on NATO's website and sent to you after the webinar. Finally, I'd like to mention that if Bob is not able to get to your question, please feel free to email him. I think his contact information is on the final slide, and he will get back to you. With that said, please welcome Bob Lloyd.
Well, thanks very much, Laurie, for that introduction. And it's good to be back with you for session number 2 of the NATO-sponsored series. Our topic today is one that I might argue is the most consequential. The federal cost principles are the rules that determine what you can charge to federal grants and what you can't charge and how the costs are to be documented. Now, the handouts today include the slide deck that I'll be working off of, as well as a copy of Subpart E of 2 CFR 200. That's the technical information related to the cost principles. It's the full text. And I will allege sometime during the presentation that there's no real substitute for having that document close by when you're trying to determine what to do in your federal grant charging. Now, little bit of background about the container for the cost principles. Over the past 10 years, the Office of Management and Budget in the Executive Office of the President has been engaged in a long-standing grant reform initiative. One of the things they sought to do and were successful at was to consolidate all of the federal grant management policies that applied to diverse types of organizations into a single cohesive whole. Prior to 2014, there were separate rules for governmental units and non-governmental units. There were separate cost principles for colleges and universities, state, local, and tribal governments, and nonprofit organizations. All that ended with the original adoption of Title II of the Code of Federal Regulations, Part 200, the official title being Uniform Administrative Requirements, Cost Principles, and Audit Requirements for Federal Awards. The shorthand name is the Uniform Guidance, and most everybody has picked up on that in the interim period. Now, one of the things OMB promised to do when they issued that consolidation was to make a review of the requirements every 5 years. And that actually was initiated in January of 2020. Unfortunately, in March of 2020, something called COVID showed up on our shores. And OMB's attention with respect to grants management was diverted to dealing with the biggest infusion of federal grant funds ever in our history, with the CARES Act, the American Rescue Plan Act, and other enactments which flowed funds to governments and non-governments throughout the country. Well, OMB tried to stay a little bit on track related to the revisions that they sought. And in November of 2020, they issued some changes, some of which have been carried forward and implemented in ways that affect RDOs. But in in February of 2023, OMB tried to get back on track with its 5-year review. And it published a request for information where they urged interested parties to send in comments about how the uniform guidance was working. And this was a really smart move on their part because they received over 1,700 sets of comments related to things that the recipient community as well as federal officials thought needed to be changed. And that gave them a real bite at the apple in terms of additional grant reform. Those proposed revisions collectively were published on October 5th, 2023, with another request for comment. And for 60 days thereafter, OMB was in receipt of letters that were significant and bulky in terms of what needed to be done. I was fortunate enough to assist NATO in its commenting on those rules. And NATO can take some credit for some of the most important changes that will benefit its members. And we'll be talking about that a little bit as we go through the discussion of the cost principles. Now, if we can move on to slide number 6, I think it's important for you to know a few things about OMB. And OMB regards their audience as federal agencies. When they issue a proposed or final document, it's addressed to the federal agencies themselves. They expect the federal agencies to take what has been given to them, implement it, and deal with the recipient community in a direct manner. And so oftentimes OMB, if they're queried at all about a particular policy, they'll push back and say, you need to talk to your grantor agency about that. Now, they also were dealing with a significant burden in terms of information. Soliciting comment from the general public is a potentially burdensome exercise. And once again, OMB spent considerable time from February of 2023 through April of this year in finalizing the document that we're referring to. While next week, October 1st, 2024, is a significant date in the development of the uniform guidance. All of the changes that OMB has made in this latest iteration take effect next Tuesday. And so we're at a particularly good time to be looking at what's changed, what hasn't changed, and what the implications of that are. Now, one other group you might want to be aware of, that somewhat working in the background right now, but I think will become more prominent as time goes along, is something called the COFA. On the bottom, the last line of slide number 6 is an acronym, COFFA. That stands for Council on Federal Financial Assistance. It is a membership organization, if you will, chaired by the Office of Management Budget and by a representative of one of the 24 federal agencies that are part of the council. And their job going forward is going to be to continue to monitor these policies and hopefully continue to make improvements in them. But every member of the COFA is a senior official in the financial management or grants management function within their department or agency. So these are really the chief grants management officers, even though that's not a term of art that's used. Now, somebody's asking the question, what does COFA stand for again? Council on Federal Financial Assistance. Okay. Some of you who've been around the field for a while may remember an earlier iteration called the COFAR, C-O-F-A-R, Council on Federal Assistance Reform. I guess OMB thinks they've concluded reform, and now they're going forward with administration. Now, let's move over to slide number 7 and talk about the cost principles themselves. Now, this is currently applicable to federal awards received by various types of performers: state, local, and tribal governments, institutions of higher education, whether they're 2-year schools or 4-year schools or degree granting institutions all the way to PhD. Any of those kinds of organizations are covered by the uniform guidance, and specifically Subpart E, the cost principles therein. Now, there are 2 other sets of cost principles out there. One is for hospitals, and that is memorialized in 2 CFR 200 Appendix Roman numeral 9. I'm not sure why OMB didn't fold them in with the others, but suffice it to say that they are a separate freestanding set of cost principles. My theory is that it's probably got something to do with 2 major federal medical or health-related policies, Medicare and Medicaid. But, OMB has never really explained their logic in leaving it as a separate document. The other is the cost principles for commercial organizations. Those are contained in Title 48 of the Code of Federal Regulations, Part 31. Title 48 is known in the vernacular as the FAR, F-A-R, the Federal Acquisition Regulation. And that's the set of rules that applies to federal contracts, not to grants and cooperative agreements and subawards. But because it applies to commercial organizations, and because the federal government's the biggest buyer in the world, the federal cost principles for commercial organizations kind of take on a life of their own. For federal awards that are covered by 2 CFR 200 Subpart E, that includes grants, cooperative agreements, and federal contracts. Now, I doubt very seriously that most RDOs have federal contracts at all. Your activities are pretty much confined to federal assistance, and the instruments used there are grants and cooperative agreements. The administrative requirements for grants and cooperative agreements are the same. The distinction is a programmatic one. If you get a cooperative agreement, and some of you I know do, it is an assistance award in which federal government involvement during performance is substantial. So arguably, the federal agency is going to be linked to a recipient in terms of programmatic activity. Places like the Environmental Protection Agency, the Department of Energy, Department of Transportation, those are agencies that have a certain portfolio of cooperative agreements, because the technical matters that those agencies are funding may be beyond the capabilities or knowledge of a particular grant recipient. Any of you who are not involved in EPA's Brownfields program will know about that. Now, going back to the basic idea behind the cost principles, they are rules for determining what costs can be charged to federal awards, what costs can't be charged, and how the costs are to be documented. On slide number 8, I point out that these cost principles are used early and often in federal grant awards. And let's start out with the first thing, where the federal agency decides the nature of the award instrument. One of the things that you may encounter going forward is the possibility of obtaining what's called a fixed amount award. That is the federal assistance equivalent of a fixed price contract. It is an award in which The grant is for a specific amount, and it is based upon a budget that is constructed ahead of time, but which the awarding agency determines is what the project should cost. And under these circumstances, that particular amount is not going to be subject to cost review after the project or program is over. Okay? Now, that makes a lot of people's minds explode because they're not used to that sort of thing in the federal grant environment. But any of you who've been involved with the Federal Emergency Management Agency, and unfortunately, I think a lot of us are going to be dealing with FEMA in the not too distant future. FEMA has pioneered activity related to fixed amount awards. That being said, probably most of the awards you're ever going to receive from the federal government will be cost type awards, in which the determination of the final amount of the award at the end of the day is determined based upon your assertion and reporting of allowable cost. Now, it goes on. The application that you submit for a federal grant has a requirement for the inclusion of allowable costs only in the submission. Basically, the cost principles serve as a good template for figuring out what costs you are going to need to be able to expend. And the awarding agency is going to conduct cost analysis of that grant budget to determine whether the costs that have been included are necessary, reasonable, and allocable. Programmatically necessary, reasonable as to amount, and beneficial to the potential project or program. And those terms, necessary, reasonable, and allocable, at some point should be rolling off your tongues easily because it comes up over and over again. Now, the award agreement represents the approved budget. But one of the things about the approved budget is that it's really a plan. It's not an ironclad, concrete document, because stuff happens during the life of a project or program. Your cost estimates in your proposal, your application, were just that. They were estimates. And stuff happens during the life of a project or program that may change what those numbers will be, and perhaps even introduce the need for costs that aren't considered at all. Now, the next two steps are where the rubber really meets the road. At the point where an organization has an approved federal grant award, the determination of expenditure of funds is made by the awardee. You're the ones who are going to decide whether to charge a particular cost to a project or program that you've received an award under. I've alleged for years that one of the most common questions that comes up in a federally funded organization is, can we charge this to our grant? And the answer usually is, it depends. And what it depends on is what the cost principles say. Now, during that time period when an organization is running their project and program, incurring cost, posting that to their books and records, at some point, there's going to be a reckoning. And that reckoning involves financial reporting. Now, those of you that get money directly from the federal government, and I know many RDOs do, you're going to be using the standard form 425, the federal financial report, to support your claims for the allowable costs you've incurred. There's a certification on that form, and I will quote it to you. I certify to the best of my knowledge and belief, all data in this report are true, complete, and correct. I understand that any false, fictitious, or fraudulent information may subject me to civil, criminal, or administrative penalties. And then there's a citation to Title 18 of the United States Code, Section 1001. That's a federal criminal statute that makes it a crime to make a false statement to the federal government, not just to the FBI, but to a grants officer that you submit a financial report to. And another point I've made, particularly when the audience is primarily program people from grantee organizations, is that certification is why the people in finance act like they do. Because somebody's going on the record saying, we've got books and records to back up that information, okay? Now, ultimately, the acceptance of those claims is something that is done by the awarding agency, but the question of how much scrutiny those claims get in that process is somewhat ambiguous. If your organization spends more than a threshold amount of federal funds annually, and the current threshold is $750,000 annually from all sources, then you'll cause to be performed an independent audit under the Single Audit Act of 1984. That audit is the federal government's first line of defense against mischarging of federal grant programs. And one of the things the independent auditor will do is to sample financial transactions to determine whether they were for allowable cost. Now, sampling the transactions doesn't get to auditing every cost that occurs. And so the auditor is trying to provide reasonable assurance that the information in the financial statements of the organization and something called the Schedule of Expenditures of Federal Awards is accurate in all material respects. So as you can see, the cost principles play a role throughout the entire life cycle of a particular federal grant. Now, moving over to slide number 9, how do the principles find their way to you? Well, first off, by federal agencies' regulatory adoption of 2 CFR 200. Back on December 26, 2014, 35 federal agencies, all of them with grant authority, issued policy that said we adopt and give regulatory effect to 2 CFR 200. They adopted the current version of that document. That means that in 2020, when there were revisions made to 2 CFR 200 and effective next week, those agencies don't need to do another thing because they've adopted whatever is in 2 CFR 200. The federal awarding agency's inclusion of Subpart E in the primary award document is what flows that to a prime recipient. 2 CFR 200.211 is a template that the federal agencies are given by OMB to say, this is what needs to be in a federal grant agreement. Now, if OMB had its druthers, it would like every federal grant agreement to look the same. Federal agencies aren't comfortable with that sort of thing, and OMB gets pushed back whenever it tries to standardize anything. I've got a good friend who used to work at OMB, and he told me many cases where federal agencies pushed back on something and said, we're different. And OMB said, go back to work and do it our way. And those kinds of conflicts certainly play themselves out within the federal bureaucracy. A pass-through entity, which is an organization that receives a federal receives a federal grant from the government, is one that turns around in many programs and subawards or sub-grants to lower tier organizations. Now, RDOs are at the intersection of many of the programs where this sort of thing is going on, whether it's the Older Americans Act or the Workforce and Opportunity Act, transportation programs, housing and community development programs. Many of them are designed with a multi-tiered activity related to this process. So the pass-through entity throwing through the requirements that are imposed by the federal agency into the subaward agreement, that is memorialized in 2 CFR 200 332A. If you want to know if you want a cookbook on how to write a subgrant, go to that section of the rules and see that there's a pretty simple and straightforward listing of the kinds of things that need to be in there. Now, any references to the cost principles in these types of agreements will probably either be 2 CFR 200 Subpart E or 2 CFR 200 400 to 476, which are the selected items of cost that are listed in the principles. Now, OMB has retained some basic concepts throughout the evolution of the cost principles. And on slide number 10, I pick up on some of those, which, I will say that I think a lot of folks try to use the cost principles like they're a dictionary. They go in and they're trying to find the answer to a particular question, and they end up, in many cases, being frustrated because the document isn't organized like a dictionary. In fact, what you sometimes need to consider is some of the general principles and policy guidance that OMB presents up front in 2 CFR 200. Recipient and subrecipient responsibility for employing sound management practices. Those sound management practices include things like meeting the financial management standards that are contained in 2 CFR 200. The discussion that the federal government has with respect to what your accounting system needs to look like. The procurement requirements, or what we use when I was working in local government, what we called purchasing. Going through a sound management practice of going out into the marketplace, shopping around, getting the best deal you can, and then getting what you pay for. Recipient and subrecipient autonomy related to organizational structure, staffing, and management. This is certainly something that evolves, particularly in respect to state and local and tribal governments. Okay. Constitutional scholars are fond of talking about the fact that we are a nation of states and that federalism is a concept that's built into our Constitution. Well, because it's built in there, the federal government, if you can believe this, and I can, it has a certain amount of deference to the prerogatives of state governments, particularly Indian tribal governments, and so on. And so the decision about how those organizations are structured, how they staff themselves, and the management procedures they carry out get not just a nod, but a real shaking of the head. Recipient and subrecipient prerogatives relating to charging practices. The determination of whether you charge a particular cost on a direct cost basis or an indirect cost basis is, to a great extent, determined by individual grantees. Okay? The idea that you charge something indirectly because it's too much trouble to break it out according to the relative allocability or benefit there too. And so, one feature that we frequently run into is a lot of people want to compare indirect cost rates from one to another. I'll call that a fool's errand, because you got to know what the charging practice of the individual organization might be, and whether or not, for example, they charge certain kinds of administrative functions in an indirect cost pool as opposed to breaking it out award by award in terms of what's benefited. There's no profit in federal assistance awards, as distinct from acquisition or procurement awards. A federal contractor can earn a profit based upon the risk they encounter related to serving the government's needs. What you're going to get in a federal project or federal assistance project or program is you're going to be able to recover your full cost, but no increment above cost. Now, I will say that the fixed amount award exercise that's being expanded does call into question that particular statement, but by and large, it's still an accurate arrangement. Ultimately, at the end of the day, when you administer a federal award, you're going to recover the allowable direct costs, allowable under the cost principles and the statute under which the program is awarded, the allocable and allowable indirect costs, and subtract any applicable credits. Applicable credits are those receipts or reductions of expenditures which serve to offset federal awards as direct or indirect costs. They're things like purchase discounts, program income, rebates and allowances. Those kinds of things are identified in the cost principles of being something that needs to be subtracted before you make the assertion related to cost recovery. Now, a little more about the issue of direct versus indirect costs, because this is one of the most commonly misunderstood concepts in federal grant activity. Slide number 11 picks up on this. They're really terms of accounting convenience, okay? We charge something directly because we can identify it specifically with a particular award. The only reason we incurred the cost was to benefit that project or program. Now, we don't end up with a lot of arguments about that, but the notion is that that can be assigned relatively easily with a high degree of accuracy. And that's a quote right out of the cost principles themselves. So it's easy to bean count, if you will. Indirect costs, or sometimes known as F&A, or facility and administrative costs, are costs that are necessary for overall operations, but it's difficult to show benefit to specific awards, again quoting the cost principles, without effort disproportionate to the benefit received. In other words, it's too much trouble. So, for example, probably a lot of the folks who are tuning into this webinar work in the finance unit of the RDO. Does it make sense for an individual who works there, who it might be working on 5 different grant projects in a single day, to have to break that out on their timesheet on an ongoing basis? Doesn't it make more sense to simply take the salary and fringe benefits of that individual, put that in a pool along with other kinds of costs similarly incurred, and spread those costs on a general basis to all benefiting activities? The answer to that is yes. And so, some of you have probably heard the expression close enough for government work, and everybody kind of chuckles about that. Well, close enough for government work is alive and well in the area of indirect cost recovery. And as Laurie mentioned in her introduction, the next webinar on October 2nd is going to drill down on indirect cost recovery for RDOs. Now, if you don't take anything else away from today, take away what's on slide 12 and 13. The general tests of allowability. I like to refer to that list as the hurdles that every cost has to go over before it gets charged to the government. Even if the cost is explicitly listed elsewhere in the cost principles as being allowable, it's still got to meet these criteria. So let's run through them. The cost must be necessary. Now, we could amend that statement, programmatically necessary. It's a kind of a cost that you need to incur in order to be able to do the work that you're going to do under the award. The cost must be reasonable. Now, more on that in just a minute, but suffice it to say at this juncture, reasonableness is in the eye of the beholder. And so this is oftentimes a situation where we have disagreements that bubble up. The cost must be allocable. Another word for that is beneficial. It must benefit the project or program either exclusively or remotely to be able to be charged to that program. It must conform to properly imposed limitations. Now, there are some federal programs where Congress has stepped in and identified a particular dollar limit related to a particular kind of expenditure. And when something is in federal statute, it takes precedence over everything else in the grant legal lexicon. We call that a statutory override. And this does pop up in certain situations. Not a lot of them, but the key word in that thing is properly imposed. Sometimes an awarding agency will try to impose a limitation. And when you try to ask them where that limitation is stated, they start to get a little squirrely. So, being able to sort that out is important. Consistent with organizational policies uniformly applied to all activities. Now, one of the things the federal government has done, and they've done it ever since the 1950s, is to say in federal assistance activity, we know you're not going to give away the farm with your own money. So if we tie the federal policy to what you do with your own funds, we've got a reasonable expectation of accountability. And that's particularly true with organizations that don't get the predominance of their funds from the federal government. Many state and local government entities, get 10 or 20% of their annual budget from the federal government. Unfortunately, or maybe fortunately, RDOs are much more predominantly federally funded. And so, your organizational policies need to reflect a certain amount of accountability and, not be viewed as potentially wasteful. Consistently treated. Now, this gets back to our direct versus indirect concept. Once an organization decides to charge a particular cost directly, it must do that for the entire portfolio of awards and activities of the organization. Okay, you can change your methodology next year, but within a particular fiscal period, consistent treatment is a requirement. Over on slide 13, determined in accordance with generally accepted accounting principles, GAAP. Now, there are a few exceptions for governmental units, and that may very well apply to some of you, but generally accepted accounting principles for governmental units are set by a private group called the Government Accounting Standards Board. They're located up in Norwalk, Connecticut. Okay, they have a companion organization known as the Financial Accounting Standards Board, which pronounces accounting standards for commercial and nonprofit organizations. So that's where nonprofit entities, colleges and universities would get their generally accepted accounting principles. But what are the kinds of things they're talking about there? Well, a good example has to do with compensated absences, the cost of annual leave, sick leave, holiday pay, etc. And both of those standard setting bodies have a standard that has to do with how to account for the various nuances of compensated absences. We don't need to go deep into that at this juncture, but suffice it to say that sometimes OMB defers over to GAAP rather than restating something in the principles themselves. Not charged elsewhere, okay? No double charging. Now, there's a number of features in the uniform guidance that are intended to prevent that sort of stuff from taking place. Now, this is the next one on the list, that OMB added in 2020, incurred within the budget period. And what that led to is the fact that there was nothing in the cost principles that addressed the cost of closing out an award. As I'm sure most of you are aware, the cost of closing out an award is all going to be incurred after the performance period is over. Submitting the final financial report, the final performance report, dealing with property disposition, those kinds of tasks. And somebody needs to do that. And that somebody wants to get paid. So the expenses associated with that are something that OMB has ridden in on a white horse with in the 2024 revisions. Okay, so the exception for closeout costs is now contained in 2 CFR 200-403. Finally, adequately documented. Now, this is another place where I think a lot of people are surprised to find that the federal government doesn't prescribe a significant amount of documentation specificity. Okay, there are a few places where there's some basic structure. For example, the discussion of time and effort reporting in 2 CFR 200-430. Basically, adequate documentation means you've got a time and effort report that meets the standards in that section. Okay. On the other hand, there's nothing in the rules that talks about what your travel voucher needs to look like and what data needs to be included in it. And so I venture to say that if we did a survey of all the attending RDOs and say, send us a copy of your travel voucher, we'd have a real smorgasbord of activity. But you know what? What's important from the federal government standpoint is whatever you say the documentation needs to be, you need to consistently follow that documentation throughout your financial activities. Now, I said we'd go a little deeper on the subject of reasonableness. Slide 14 attempts to do that, okay? OMB says that a reasonable cost is a cost that a prudent person in the circumstances surrounding the incurrence of cost would incur. If we can just find that prudent person, we'll be okay. But the factors that they then list as affecting reasonableness really get to the situation of what are the conditions under which the cost is being incurred. Is this an ordinary and necessary expense, something you have to spend money on in order to be in business of the type of entity you are or perform the kind of award you're doing? Did you use sound business practices? So that doubles back again. Incurred by arm's length bargaining. You're not engaged in some form of self-dealing. You're not renting from yourself or, buying from an organization that's under common control. And if you think that's a ridiculous statement, I would urge you to take a look at the Inspector General's webinar, not web, the Inspector General's website, where all of the federal agencies have Inspector General reports in archive, and see how often the issue of less than arm's length bargaining comes into play. Adherence to federal, state, local, tribal, and other laws or regulations. You've got to be following whatever the applicable laws are in the place of venue that you're carrying out. And so, this may have some impact on, what kinds of costs you can incur. A good example is where a nonprofit organization needs to be licensed by the state or have a business license from a local government. You can't perform without those. That starts to say it's reasonable to pay the cost of doing that. What are the facts and circumstances? So oftentimes, one saving approach with respect to the cost principles is for organizations to create either a policy that they continue to use throughout their financial activities or a documentation of the reasons why certain kinds of things occurred. And again, thinking back on the kinds of expenses that occur when FEMA is funding activities, what were the facts and circumstances concerning the presidentially declared disaster, and more importantly, the conditions on the ground as recovery and reinvestment begins. Finally, unjustified deviations or exceptions. The notion that, you follow your policy, but there may be circumstances in which you depart from the policy, and documenting those departures becomes the basis for a reasonable cost under the circumstances. Now, in all the listing that I did on this slide, what's missing? The answer to that is the practices of the federal government itself. Okay. A good example has to do with travel costs. The travel cost principle says that an organization like yours needs to have a travel policy that addresses how people who travel on official business for the organization will charge their costs and what will take place with respect to airfare, lodging, meals and incidental expenses, and so on, needs to be part of that policy. Well, what the government says, in the absence of an acceptable policy of your own, the federal government's policy related to travel by federal employees will be the default alternative. Well, some organizations would be delighted to have the federal travel rules applied to them, but they're restricted in some other fashion by their own organizational policies or perhaps by state law. But the point I'm making here is just because the federal government does something, that's not an excuse for the federal agency to say, well, that's a reasonable cost. One other you might think it's a silly example, I don't, but what about federal holidays? Okay. When I've done a bunch of live programs and have everybody in the room, one of the things I frequently do is ask people to raise their hands if their organization gives Columbus Day off. And, invariably there's a smattering of hands that go up. How about Veterans Day? More hands go up, but not nearly as many as go up when they talk about Thanksgiving. And, one of the things that's occurred fairly frequently these days is employers who've given the day after Thanksgiving off because, they're recognizing that very few people would show up anyway. My point here is the federal government's practices, while they may be something to look at, are not something that's enforceable related to the cost principles. Okay, slide 15, allocable cost. Okay. Now, the notion here is cost allocability is at various levels. Sometimes the cost is incurred exclusively for the federal award. I use the word exclusively. The cost principles say specifically. I think this is more helps be more definitive. Costs incurred to benefit the federal award or other activities if the recipient or subrecipient of the recipient or subrecipient that can be distributed in reasonable proportion to the benefit received. Those are what are known as common costs, and they are most likely charged on a direct basis. So somebody who's working on multiple projects charges their time and creates an underlying time and effort report that shows that distribution. Costs that are necessary for overall operations, but for which a direct beneficial relationship is difficult to show without disproportionate effort. Again, that language is OMB's own, and that's where we deal with indirect costs. Yes, it's a necessary expense, but being able to dice it up into small pieces and show how it benefits individual projects is, not necessary. So it's heard often under those latter circumstances, close enough for government work. Slide 16 gets to the issue of your grant budget. And OMB's, again, quoting from their document, the approved budget for the federal award summarizes the financial aspects of the project or program as approved during the federal award process. Now, that's sufficiently broad to apply both to the federal government when they're making the award or a pass-through entity when they are. It also recognizes that it's up to the recipient to manage their budget or subrecipient commonly. And so what are those responsibilities? To exercise budgetary control. One of the reasons why the federal government uses the Standard Form 425 financial report and the Standard Form 424, the application for federal assistance, demonstrates the distinction here. When you submit a grant budget to a federal agency and do so on the Standard Form 424, you're breaking out the individual costs. Personnel, fringe benefits, travel, equipment, supplies, contractual, my favorite, other. Okay. When you submit the Standard Form 425, we don't have a copy of it in front of you, but I will certify to you that it has no line items on it. You're identifying in the aggregate amount what you've spent during the particular quarter. Well, the point is, it's up to you to manage the budget and to decide how to charge the costs that are approved in that particular context. And again, determine cost allowability. The sections that I've cited there on slide 16 tie back to the duties and administrative responsibilities that a recipient would have. And since that also applies to subrecipients, makes it clear. Dealing with unbudgeted costs. There's nothing in the rules that says your costs have to be identified within an approved budget. Part of the reason, that you're given the cost principles as a tool, as part of your award, is if something comes up in the course of doing business that isn't mentioned in the cost in the budget, then you confront that by looking at the cost principles and see whether it's an allowable cost and whether it meets the general tests of allowability that we talked about earlier. Recipients are required to report budget deviations, but not necessarily to get prior approval for those budget deviations. And so the sections that I've cited there focus in on the matters that relate to budget management on the part of an organization and how the cost principles affect that budget management. Now, over on slide 17, we head in the direction of the place where probably a lot of you have spent time when you've worked with the cost principles. and that's what's known as the selected items of cost. They were selected by OMB for several different reasons. Either they are a type of cost that's commonly encountered when an organization does business with the federal government. Okay? Things like compensation for personal services, equipment, supplies, travel, facility occupancy. All of those things are not only necessary, but they're probably common in most organizations that are receiving grants. Alternatively, there are a few costs that are identified because they're specifically disallowed. Okay, we got along for many years in the cost principles without mentioning booze, alcoholic beverages. OMB put it in there because somebody tried to charge alcoholic beverages as meeting expense or employee health, morale, and welfare. We can chuckle about that. Yeah, there are also some cost principles that deal with particular classes of award performers. And this comes into play in two key places. One has to do with higher education. There are a number of kinds of expenses that take place on a college campus that aren't going to be charged to the government. Things that have to do with student services, things like athletics and so on. Those are out the window. On the other hand, the kinds of costs that are going to take place in federally funded research and in various kinds of education programs at that level are blessed within the cost principles. The other category is organizations that are performing internationally. When you go through the selected items of cost and you get to the listed item that says exchange rates, you're asking the question, why is that even in there? Well, non-governmental organizations, charities that are performing awards overseas frequently have to deal with fluctuating currency. They take American dollars and convert them into local currency and experience a loss or a gain when that kind of change occurs. They needed some guidance about how that would be helped, and OMB put it in the cost principles. Now, the bottom line here is that the document is really an interpretive arrangement. And by that, what we mean is that you apply the principles to the facts and circumstances that you're encountering in the course of doing business in this award. Slide 18 is an attempt to capture, I think, some common sense approaches to the issue of cost principle interpretation. And the reason I've included this is because of the phrase that's quoted at the top of slide 18. Failure to mention a particular item of cost is not intended to imply it is either allowable or unallowable. Rather, determination as to allowability in each case should be based on the treatment provided for similar or related items of cost. Well, who's going to make that determination? The recipient or subrecipient who's operating the program in real time. So, the criteria that are outlined in 2 CFR 200, factors affecting allowability of cost, must be applied in determining allowability. And 200-403 is where the concepts of necessity, reasonableness, allocability, and so on that we talked about a little bit ago. Now, I'm going to suggest a way to think about cost allowability using the 4 principles or the 4 concepts that are listed at the bottom of slide 18. And maybe we could use as an analogy the academic grades that you and I got in school. A, B, C, and D. Okay, all of those were passing grades, but some of them were better than others. Well, an A is where there's an explicit mention in the uniform guidance 421 to 476 that a cost is allowable. That might be considered the gold standard. We don't have a lot of arguments about that one. Principles applicable to similar or related items. Okay. Earlier, I mentioned to you that OMB, for reasons that they have not explained, never ruled on the issue of closeout costs until the document will take effect next Tuesday. Okay. However, one could have made the assertion that closeout costs were allowable, by going to a couple of other cost principles that were in effect at the time. One of them was termination costs. When a program or project is cut off, the recipient still has to do final financial reports, final performance reports, deal with disposition of property, and they may be in a lot of trouble with the federal government, but they've still got to deal with those sorts of things. Well, if those kinds of costs were allowable when somebody's terminated, why wouldn't they be allowable when somebody's engaged in routine closeout? Now, fortunately, going forward, we don't have to make that interpretation. But I think that was one that I know carried the day in a number of specific circumstances. Treatment and other cost principles. Now, back in the day when there were 5 sets of cost principles, before OMB consolidated 3 of them, one might be able to have gone to a different set of cost principles to see if a particular cost was addressed. Now, that still is a possibility because the hospital cost principles and the commercial cost principles are outliers. And particularly the commercial cost principles have some discussions in them that may help inform a decision to charge the cost to the federal government. Now, if you can't find it in any of those places, then going back to the reliance on the general tests of allowability might be the appropriate thing to do. But what I'm pointing out here is a thought process that an organization needs to make on its own. The fact that somebody like myself might think that there's a path to cost allowability doesn't do you much good when you're being challenged by an auditor or a federal official related to that. Okay. So, many organizations being sufficiently risk averse will probably stick with, the first item, the explicit mention within the cost principles. Others may be a little more aggressive in terms of taking a position that a cost is allowable because they've interpreted it based upon the language that is present somewhere in the principles themselves. Okay. Every December, I guarantee I get a few calls from somebody wanting to know about the charging of the cost of the annual holiday party for employees. And I would contend that if you read the cost principle on employee health and welfare, you could conclude that having an event for employees at the end of the year is something that could very well be charged to federal programs and projects. No alcoholic beverages, but a happy time related to improvement of working conditions and employer-employee relations. Well, somebody's not going to like that interpretation, and that's fine. Then don't charge it to the government. Okay. The bottom line here is, you got to do something with the interpretation that you're comfortable with and you can defend. Now, slide 19 gets to the issue of how the selected items of cost are presented. Okay. And there are allowability distinctions that fall into several different categories. Most of the time, we are not going to find a cost in the selected items that is allowable always. There's usually some sort of, special circumstances that relate to the allowability of cost. So allowable is probably a scarce category, but there's still some that are on their face allowable. Allowable under certain circumstances is where the cost principle has a certain amount of narrative about the facts and circumstances that would permit the cost to be allowable. One of the urban legends out there is that the cost of lobbying is unallowable. Well, if it's unallowable, why does it take OMB more than a page of the Code of Federal Regulations to discuss it? The answer is that there are some forms of government relations activity that would be an allowable cost. In fact, there are some federal programs where part of the duties of the grantee or subgrantee is to engage in advocacy. Those of you who get Older Americans Act money can relate to that. Okay, so the fact that there are certain kinds of government relations activities that are allowable means that an organization could distribute the cost, let's say, of the salary of the person who does government relations according to allowable or unallowable activity. Now, that individual might not like, breaking out their time and effort report and might say, well, it's not a lot of money anyway. Let's not charge it to the government. That's a common practice to think that through. Now, a close cousin to allowable under certain circumstances is costs that are allowable with the prior approval of the awarding agency. And one of the things to its credit that OMB did in the grant revisions taking effect next week is to cut down on the number of administrative actions that require prior approval. Okay. They've also defined prior approval in a much clearer fashion, and more on that in just a minute. A fourth category of cost is allowable with approval. And of course, what's missing in that discussion is prior. A good example of allowable with approval is pre-award costs. Okay. An organization could incur pre-award costs, and once the award is in place, go to their awarding agency and say, we believe these costs are beneficial to the project or program. We want to charge it to the award. And the awarding agency can turn thumbs up or thumbs down on that, but it didn't have to occur before the award was made. Finally, we have unallowable cost, and most of those have to do with the lack of benefit to a project or program or something that's indicative of bad management. Now, over on slide 20, the likely expenditures by most awardees are probably going to be captured in the object class categories of expenditure that show up on the standard form 424A. Personnel, fringe benefits, travel, equipment, supplies, contractual, and that contractual includes the cost of professional services costs as well as the cost of subawards. Construction. Now, you might say, why is construction in a non-construction budget? Because there are some kinds of things, such as facility renovation or accommodation of the project or program, where construction might be necessary. And so that's why it's there. And finally, others would be all of the other things that are listed as allowable or unallowable in the selected items of cost. Slides 21 and 22 capture what might be some understandable cost groupings. But the problem with the selected items of cost is that they are basically listed in alphabetical order. As recently as Tuesday, I had a client contact me and ask the question whether there was a simple guide, kind of a cheat sheet related to the cost principles that they could use in making cost determinations. And my response to them was, I don't think there's a cheat sheet, in part because the allowable under certain circumstances requires you to really look closely at what the nuances are related to a particular item of cost. And so, there really is no substitute for having the cost principles at hand and picking them up and looking at them to help make decisions. I've been working in this field for over 40 years, and there's probably not a day goes by that I don't go back to some part of 2 CFR 200, and particularly to the cost principles, and remind myself what it says and what kind of exceptions there might be, and so on. Now, particularly with respect to unallowable cost, the notion here is that those costs are presented in the fashion they are because there's either no benefit to the project or program, or they are indicative of poor management. But let me embellish that on that a little bit. The cost principles have been written over time by staff members at the Office of Management and Budget. Not every one of them majored in English composition. And so sometimes the semantics related to the cost can be something that trips people up. And let me give you an example of that. I want you to think about the cost that you would incur when you're on official travel and you have to change your flight. And, it may be because of delays, it may be because of a change in your mission, whatever the reason, you've got to change your flight. And the airline says to you, you need to pay an additional amount for changing that flight. Now, is that a fine or a penalty? Is that a fee? Is it a travel charge? Those terms would in and of themselves could create a problem in terms of the allowability. Fines and penalties are unallowable. Okay. Fees are not. Okay. And so, being able to properly classify what's going on might lead to, assuring that the cost is reasonable and necessary under the particular project or program. Now, let's go on to slide 23, and just got a couple of other issues to talk about and still hopefully get in a little bit of time for some of your questions. Slide 23 focuses on the cost policy impact of the 2024 changes. Now, I think I've probably beat a dead horse on allowability of closeout costs. There's the citation that makes it clear that you can charge those costs to the federal award that's being closed out. Another area that OMB addressed is the definition of prior approval. And I say there are 4 elements to that, okay? Prior approval means affirmative statement from an authorized official incurred in advance and establishing the nature of the step. The cost must be excuse me, I'm having a little trouble with my throat here. Excuse me. Must be in writing, must be from a person who has the authority to give it, must be an affirmative statement, and must be taken before the action is pursued. Okay. If you can hit all 4 of those, you've got a prior approval that can be defended. Now, OMB has also addressed the issue of inclusion of costs requiring prior approval in the approved budget or award. And there's a citation to the section that's addressed. Well, approved budget implies prior approval. Now, the question of whether pass-through entities have all of the prior approval authorities the federal government has not really been effectively addressed. And so one of the things I would recommend is if you're dealing with a pass-through entity and want to establish clearly what prior approvals are necessary, or if you're the pass-through entity yourself, this is something that should be memorialized in the award document. OMB gave federal agencies the right to waive certain prior approvals. And those of you who've been around since COVID started will remember that under the CARES Act and even under the American Rescue Plan Act, there were numerous administrative and cost principle issues that were waived because they were more trouble than they were worth. Now, OMB reduced the number of prior approval actions in 200-407. I think the way 200-407 was first developed is somebody at OMB did a word search for the word prior approval and found 24 areas where there was a specific mention of that concept. Well, suffice it to say that 8 of those 24 have breathed their last. OMB has cut down the number of things that need prior approval. And they've also eliminated the terminology of an advance understanding. Now, I think that's a pretty good concept, but OMB uses it and says sometimes an awardee, recipient or subrecipient, may want clarification about whether a particular cost is allowable and can seek prior approval, even though they're not required to do so. Now, with respect to those that are still on the list, the cost principles make it clear that it's up to the awarding agency to determine whether those will be enforced or not. Another key change has to do with the definition of equipment. The current policy at the federal level is that a piece of equipment is a piece of tangible personal property having a useful life of more than 1 year and a unit acquisition cost exceeding $5,000. On a federal grant budget, anything that's above that $5,000 threshold and a useful life of more than 1 year goes on the equipment line item, and anything that doesn't goes on the supply line item. That doesn't mean that you can't have a definition that's different, okay? Once you've got the asset in hand. And I know a lot of organizations, don't define equipment with as high a dollar value as the federal government does. The reason the federal government's got it there is because purchase of equipment requires prior approval. And so just to free up and to try to eliminate prior approvals that aren't considered particularly meaningful, OMB is changing the definition from 1 year and 5,000 to 1 year and 10,000. Okay. So once again, an organization may decide, it doesn't need to get prior approval to buy something that's a pretty good asset, large office machinery or something of that sort that you're going to treat as a piece of equipment, but you treat it as supplies for grant budgeting purposes. Now, that same definition, 1 year and $10,000, it reintroduces itself with respect to disposition of assets. But when you get to dispose of an asset, then the question is, does it have a fair market value of $10,000 or more? If it does, then disposition instructions must be sought. If it doesn't, then an organization may retain the asset, sell it, keep it, do whatever they want with it. The federal government's writing it off. Now, I have a feeling that some folks are going to encounter differences of opinion related to those particular numbers. And this might be the type of thing where, in particular, you want to, be well aware of what the federal rules say under those circumstances. Now, over to slide 24. A couple of things that have been added relate to recruitment of program participants. The expenditures associated with that are deemed to be allowable in terms of outreach. The cost of conferences is something that's been, I will call it a tennis match between the federal agencies and OMB over this matter. But it all goes back to a particular incident that occurred now close to 10 years ago, where a federal conference that was conducted in Las Vegas took on a life of its own in terms of media attention. And OMB tightened up the federal government's own policies related to conferences, and that had a ripple effect into the recipient community, even though OMB explicitly said that the restrictions they were imposing on the feds themselves did not apply to grantees. Awards performed overseas, I think we can dispense with that one for RDOs. And then we can move over to indirect cost recovery issues. Now, OMB has been fighting a battle for a number of years, trying to make sure federal agencies recognize negotiated indirect cost rate agreements issued by a federal cognizant agency. It's abundantly clear that federal agencies have no authority to step away from so-called NICRAs. The problem is that many organizations aren't able to get a NICRA because they don't receive direct federal funding, or they don't receive enough federal funding to have the requirement apply to them. And unfortunately, RDOs are in that mode. Many of you who've dealt with the Economic Development Administration as your cognizant agency and dealt with the Department of Interior, which is doing the negotiation work on behalf of EDA, have run into that particular problem. And this is not a problem that we're going to be able to solve in a single slide of the slide deck on cost principles. But suffice it to say, that's part of the reason why on the 2nd of October, we're going to spend a whole session on that subject and get to those issues as well. But one final comment related to that, and that is that OMB has been trying without much success to move away from having everybody negotiate indirect cost rates with the federal government. It's a burdensome exercise. It takes a lot of time and effort. And so trying to get fewer organizations to deal with that has been their plan. This is what led them to the creation of something called the de minimis indirect cost rate. And this was first presented in the uniform guidance issued in 2014. If you doubt that OMB is trying to get more organizations in that direction, take a look at the fact that with the revised 2 CFR 200, they are raising the de minimis indirect cost rate to 15% of the modified total direct cost that an organization incurs during an award period. And so there will probably be a number of organizations who look at, the trouble they would go to in trying to get a negotiated rate and decide that using the de minimis, while it may not result in full recovery of indirect cost, is preferable because it eliminates a lot of the back and forth that's necessary in that negotiation matter. Now, slide 26, few final suggestions. There's no effective substitute for a deep dive. Everybody's in a learning curve right now and will be for the foreseeable future. But a couple of points I would make here. One is please use the lingo, the language of the cost principles document when you're communicating with awarding agencies officials. And there's nothing more prevailing than to be able to say to a federal official, or for that matter, official from a state agency who you're dealing with, in accordance with, and then you provide a citation, 2 CFR 200 403H. And by that time, they're asking the question, what the hell is that? So consider their motivations in their responses to the cost principles. They're always looking for cost savings. They're also looking for what I call horror story avoidance. And that is, they don't want a situation arising where because there was a lenient approach to interpretation, somebody got themselves into trouble and there was film at 11. So with that, let me turn it back over to Dion and we'll open it up for any questions or comments that you have. We'll try to get those in, between now and half past the hour.
Great. Thank you so much, Bob. And I'm looking at the chat, but I don't see any questions recently posted that don't have a response. So given that we still have 10 minutes, feel free to leave a question in the chat here, or just go ahead if you're able to unmute yourself and ask it to Bob directly. We have a big crowd here, but not enough that I think that would be impossible.
Okay. Well, if you're reluctant to share your question with the group, or you have a particular fact-specific question, as Dory indicated, you can get back in touch with me later on. My email is consultloyd, CONSULTLLOYD @AOL.com. And my two adult children make fun of me by still being on AOL, but I've continued to be there because sometimes I hear from somebody who I dealt with 10 years ago, and they still can find me with that Neanderthal reference.
We'll just give it another minute to see if anyone wants to put a question in. And yes, Tiffany, I'll go ahead and take care of that. And if
Somebody wants the slide deck, Diane?
The slide deck and the recording, as well as the handout, will be shared by email after this session concludes today, and then we'll also go ahead and publish them on the NATO website. So if we don't have any questions at this time, I'm going to go ahead and conclude things here. Thank you very much, Bob, for your presentation, and thanks to the audience for joining us. As a reminder, we have 2 more sessions coming up in this series, and you can find all the information about those, including registration links, in our weekly NATO newsletter or on the website. Thanks again, and everyone, please have a great rest of your day.